QBCC, the Queensland Business and Construction Commission. Love them or hate them. I'm not going to get into a debate about that today. But if you are registered with them, then you need to provide them every year, generally 31st of December or 31st of March, a full set of financial statements. If you want to increase your turnover limit or you're applying for a new application, you also need to give them a full set of financial statements. Now, up until last week, the QBCC had some pretty nasty rules. They wanted what were called general purpose financial statements, which are kind of like the financial statements that BHP sends out. The first bit doesn't give you much information, but then there's about 85 pages behind it of all these notes that are really, really confusing. Now, I don't understand why they wanted them. The lady from the QBCC told us it's because that was what was in the legislation and they couldn't change it. Last week, yes, thank goodness they changed the rules. So now we can prepare what's called special purpose financial statements. Now, special purpose financial statements are what we prepare for you normally. There's a few extra things that we have to have for the QBCC so they can tick their boxes and check their ratios, but it's normally a trading statement, a profit and loss, a balance sheet, a cash flow statement, age payables, age receivables. So what's different in this to what we do normally? Because we do have to do a few extra things, and the question is, why do we have to do it? So firstly, we need to make sure that your assets and liabilities are all in the right areas, current versus non-current. Current means it's something that you're going to do or use or pay in the next 12 months. Non-current means it's longer than 12 months. So that means if you have loans for vehicles, excavators, equipment, then we need to class 12-month worth of repayments as a current liability and the rest as a non-current liability. As accountants, because we haven't had to do this statutorily for a long, long time, I did back way in the day when I was a junior, but that was like eons ago, we've got a little bit lazy, really, and most of us just put them all in non-current liabilities because most business owners just look at it and go, good, there's all the loans. But for QBCC, we need to split them. The statement of, and the reason we do that is so they can see their current ratios really easy. Current assets divided by current liabilities. Very, very simple. Then we need to produce a set of cash flows, and it shows us where the money came in from and where the money went out from the business. Most of us would look at the profit and loss and the balance sheet and work that out, but the QBCC want to take a shortcut. That's cool, we can do that. Then there's age receivables and age payables. Now, the reason they want them is to make sure that A, you're paying people on time, because part of the QBCC's role is to make sure that builders pay subbies. So that's why they have age payables. But the age receivables, when they're doing their ratios, if you've got some clients that owe you money that's more than 90 days old, they won't count it, which is a bit cruel, particularly when there's perhaps invoices that are being subject to retentions or invoices that are in dispute. They won't count them. So if you've got retentions, speak to your accountant, because we do treat them differently and take them out of the age receivables, so it's much easier for the QBCC rules. But yeah, that's what we do for QBCC. They want to know what's come in, what's gone out, where it's gone, and make sure that you're still liquid. So we do provide a slightly separate set of financial statements for them, because we don't want to confuse you. We know that you understand the set that we give you normally, and it makes total sense to them. We just make a few tweaks and then give the other ones to them. That's not a drama.